The property crisis in China is deepening, which is threatening its growth target of 5% this year. The unappealing economics of the plan for local governments highlights the difficulty President Xi Jinping confronts in his attempt to reverse the record low housing prices that are undermining China's growth ambitions. More in this next report.
The strategy has been an integral aspect of the government's endeavor to strengthen the real estate sector and fulfill Xi's vision of producing more affordable homes. China is already dealing with an excess inventory of 382 million square meters, the size of Detroit, and the poor results have only increased the push for harsher measures. Administrators are attempting to be frugal while balancing Beijing's demands. According to Jefferies Financial Group, apartment prices in major cities are anticipated to fall another 30% before stabilizing. The research group said as a result, it is not financially prudent for Chinese officials to buy flats at this time. Converting inventory into affordable housing is expected to yield results lower than the finance cost as well. Macquarie Group reports that 2023, the average rental return in China's Tier 1 cities was just 1.4%. That is much lower than the 1.75% funding rate set by the central bank. Some municipalities have suggested using intense negotiation to reduce their risks. However, this makes one wonder if bankrupt developers would be ready to sell their stock. The already shaky municipal finances could take a further hit as a result of this decision. Revenue from land sales has dropped to historic lows, and regional governments' budget expenditure has shrunk in the first 7 months. This reduces their capacity to stimulate growth. Only Shanghai, out of all 31 provinces and municipalities, managed to achieve a budget surplus during the first half of the year. Zelina Zheng, senior credit analyst at CreditSights Singapore, said, "We do not expect a wide rollout of the purchase program due to the lack of funding and the fact that banks and state-owned firms need to bear the full credit and investment risks." On Wednesday, a Bloomberg index tracking prominent Chinese developers fell to its lowest level since late April, falling by as much as 1%. That comes after a steep drop the day before when a program that links the Shenzhen and Shanghai bourses to the Hong Kong market kicked out several builders. While state buying of housing inventory is widely seen as a key step towards easing the glut, uptake of the central bank's funding support has also been low. Only 12.1 billion yuan, and that's about $1.7 billion, or 4% of the PBOC's 300 billion yuan re-lending program, had been utilized as of the end of June. Fitch Ratings analysts had noted that the limited use of existing financing programs signals that the returns and cash flow from social housings are insufficient to service associated debt. Bloomberg intelligence analyst Christy Hung said, "For now, China may struggle to sell its home bailout plan to local governments." Hing added, "The meager rental yields hardly justify the risk." Analysts have also been skeptical about whether the central bank funding is sufficient, as it's just a fraction of the 1 trillion yuan to 5 trillion yuan, and that is needed to fix the supply-demand mismatch. Business Bureau Report, WION World is One.